Guide to Investing, Part 1, Introduction, Why People Invest. Hey everyone! Waving hand. Welcome back to the channel. If you're new here, don't forget to smash that like button, subscribe, and hit the notification bell so you never miss a video on making your money work for you. Today, we're diving deep into investing, and I promise, by the end of this video, you'll see why investing isn't just for the rich, it's for anyone who wants to take control of their financial future. Why people don't invest, and why that's a mistake. Let's be real for a second. Most people are working hard, earning money, and watching it disappear. Bills, rent, groceries, Netflix subscriptions, you know the drill. And many think, I don't have enough money to invest, or investing is too complicated. Here's the harsh truth. Not investing is the riskiest move of all. Think about it. Inflation is eating away at your savings. A $10,000 stash in a bank today won't buy the same things in 10 years. Investing is your ticket to making money work for you, instead of you working for money your entire life. The real power of investing. Investing isn't just about making money. It's about freedom. Financial freedom, you earn money even while sleeping. Yes, literally. Imagine getting rent deposits, dividends, or interest while you're binge-watching Netflix. Time freedom, the earlier you start, the more you leverage the magic of compound interest. Think about planting a tree today versus waiting 10 years. Control over your future. Instead of depending on a paycheck or retirement plan, you create your own wealth path. Example. Let's say you invest $500 every month from age 25 to 35 in an account that averages 8% annual return. By 35, you'd have over $100,000. That same money grows to nearly $1 million by 55 if you continue. Why people fear investing? Okay, let's keep it real. Fear is natural. People worry about losing money. What if the stock market crashes? Not understanding investing. I don't know what a bond or ETF even is. Making the wrong choice. I might pick the wrong stock. Here's the thing. Fear is normal, but it's also what keeps people broke. The difference between rich and poor isn't always education or luck. It's the willingness to learn and take smart risks. Investing is learning, not gambling. A lot of people confuse investing with gambling. Let me break it down for you. Gambling, you put your money on one number, one team, or one card, and hope for luck. Investing, you research, diversify, and create strategies that tilt the odds in your favor over time. Think of investing as a skill you build, like learning to drive or cook. You don't master it overnight, but practice plus knowledge equals results. How to start thinking like an investor. Step 1. Know your why. Why do you want to invest? Retirement? Early financial freedom? Travel? Your why will guide your strategy and keep you motivated. Step 2. Start small, start now. Don't wait to have $10,000. Start with $50, $100, or $500. Platforms today allow you to invest with almost no minimums. Step 3. Learn the basics. Stocks, bonds, mutual funds, ETFs, real estate, know what each does. Understand the difference between risk and reward. Step 4. Be consistent. Investing is like a fitness plan. Showing up regularly beats occasional marathon efforts. Step 5. Track and adjust. Monitor your investments, learn from mistakes, and reinvest your profits. Real-life example. Meet Sarah. She's 25, works a 9-to-5, and thought she couldn't invest. She started with $100 a month in a low-cost ETF. She educated herself using YouTube videos and investment books. 5 years later, she has over $7,000 just from consistent small investments. Not bad for doing almost nothing extra, right? This is the power of starting early and staying consistent. Quick action steps for you right now. Open a brokerage account or investment app. Set up automatic contributions, even if small. Watch one video or read one article every day about investing. Start a simple portfolio, maybe one index fund or one stock you researched. Remember, momentum is everything. The first step is the hardest, but once you start, it gets easier and exciting. Summary of Part 1. Investing is the key to financial freedom. Fear and ignorance hold people back, but education plus action equals success. Start small, learn consistently, and think long-term. Guide to Investing, Part 2, The Relationship Between Risk and Return. What is risk in investing? Let's break it down. Risk simply means the chance that your investment could lose value. Some investments are low risk, think government bonds or savings accounts. Some are high risk, think individual stocks or cryptocurrencies. Here's the key, high risk can mean high rewards, but it also means high potential loss. Example. You invest $1,000 in a savings account with 1% annual interest. After a year, you'll have $1,010. Very safe, very predictable. You invest $1,000 in a startup company. It could become worth $2,000 in a year, or you could lose it all. What is return in investing? Return is how much money you make on your investment. Measured as a percentage over time. Can be positive, profit, or negative, loss. The simple rule, the higher the potential return, the higher the risk. Real-world example. Index funds historically give around 7 to 10% per year with moderate risk. Individual stocks can give 20% plus in a good year, but can also drop 50% plus in a bad year. Risk versus reward, the balancing act. Here's the secret most people don't realize. You don't want to avoid risk entirely, you want to manage it. Avoiding risk means your money grows very slowly, often slower than inflation. Taking too much risk without knowledge can wipe you out financially. The smart investor does 3 things. Diversifies, don't put all your eggs in one basket. Researches, understand what you're investing in. Adjusts risk over time, as you get older, reduce high-risk investments. Types of investment risk. Market risk. The value of your investment goes up or down because of the overall market. Credit risk. The chance that a company or government may not pay back its debt. Inflation risk. The risk that your money loses value because prices rise faster than your returns. Liquidity risk. The risk that you can't sell your investment quickly without losing money. Interest rate risk. Particularly affects bonds. When interest rates rise, bond prices usually fall. Risk tolerance, how much can you handle? Every investor is different. Your risk tolerance depends on your financial goals, short-term versus long-term. Your personality, are you calm during market drops or panic easily? Your timeline, how soon will you need the money? Exercise for you. Imagine your portfolio drops 20% tomorrow. How would you feel? Scared you might prefer safer investments. Excited you can handle higher risk investments for higher returns. Examples of risk versus return in real life. Government bonds. Very safe, low return, 1 to 3%. Good for emergency funds or conservative investors. Index funds. Moderate risk, historical returns 7 to 10%. Great for long-term growth without the stress of picking individual stocks. Individual stocks. High risk, high potential return. Can multiply your money fast, but also can drop drastically. Cryptocurrency. Extremely high risk, extremely volatile. Only for those who can tolerate big swings and potential losses. The rule of thumb, don't risk what you can't afford to lose. Only invest money you don't need for living expenses or emergencies. High-risk investments should be a portion of your overall portfolio, not all of it. Example. Emergency fund equals 6 months of living expenses. Low-risk investments equals 50% of investable money. Medium risk investments equals 30%. High risk investments equals 20%. How to manage risk. Diversification. Spread investments across stocks, bonds, ETFs, and real estate. If one investment drops, others can balance the loss. Dollar cost averaging. Invest a fixed amount regularly, regardless of market conditions. Reduces the impact of market volatility. Rebalancing your portfolio. Adjust your investments periodically to maintain your target risk level. Continuous learning. Stay informed about markets, companies, and investment trends. Knowledge reduces risk more than luck ever will. Real life story, risk management pays off. Meet Alex. He invested $5,000 in a single tech stock in 2019. By 2020, the stock lost 50% of its value. Most would panic and sell at a loss. Alex diversified, kept investing in index funds, and held the tech stock long-term. By 2023, that $5,000 grew into $12,000 thanks to market recovery and diversification. Lesson: risk is real, but smart management can turn temporary losses into long-term gains. Actionable steps for you today. Assess your risk tolerance, take a quiz or journal how you feel about potential losses. Diversify your investments, don't invest everything in one stock or fund. Start dollar cost averaging, even $50 to $100 a week can grow massively over time. Educate yourself on each investment, never invest blindly. Track and adjust, check your portfolio quarterly and rebalance if needed. Summary of Part 2. Risk and return are inseparable. Understanding your risk tolerance helps you make smarter choices. Diversification, dollar cost averaging, and continuous learning are your tools. Investing without managing risk is gambling. Managing risk intelligently is the path to wealth. Guide to Investing, Part 3, Most Common Types of Investments. Why knowing investment types matters. Many beginners make the mistake of putting all their money in one type of investment. This limits growth potential. Increases risk if that investment fails. By understanding different types of investments, you can diversify your portfolio. Match investments to your risk tolerance. Optimize returns over time. 1. Stocks. What are stocks? Stocks represent partial ownership in a company. When you buy a stock, you own a share of that company. Why invest in stocks? Potentially high returns over time. Dividend payments can provide passive income. Risks. Stock prices can fluctuate dramatically. Individual stocks carry company-specific risk. If the company fails, your investment can drop significantly. Example: buying shares in Apple or Tesla. If the stock rises 20% in a year, your investment grows accordingly. Tips for beginners. Start with large, stable companies. Consider index funds or ETFs to reduce risk. 2. Bonds. What are bonds? Bonds are essentially loans you give to companies or governments. They pay interest over time and return the principal at maturity. Why invest in bonds? Lower risk compared to stocks. Provides predictable income through interest payments. Risks. Interest rate risk. If rates rise, bond prices fall. Credit risk. The issuer may default. Example: buying a U.S. Treasury bond, safe, but low return, 1 to 3%. Tips for beginners. Use bonds to balance a high-risk portfolio. Consider bond ETFs for diversification. 3. Mutual funds. What are mutual funds? A mutual fund pools money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Why invest in mutual funds? Diversification without buying individual stocks. Professionally managed by fund managers. Risks. Management fees can eat into returns. Market risk still exists, depending on what the fund invests in. Example: a growth-focused mutual fund invests mostly in stocks for higher potential returns. Tips for beginners: check the expense ratio, lower is usually better. Pick funds that align with your risk tolerance and goals. 4. Exchange-traded funds, ETFs. What are ETFs? Similar to mutual funds, but traded like stocks on an exchange. Can track an index, sector, or commodity. Why invest in ETFs? Lower fees than mutual funds. Can diversify across stocks, bonds, or commodities easily. Risks. Market risk, your investment can go up or down. Some ETFs may be more volatile, depending on what they track. Example: S&P 500 ETF tracks 500 top U.S. companies, providing broad market exposure. Tips for beginners: start with broad market ETFs. Avoid very niche ETFs until experienced. 5. Real estate. What is real estate investment? Buying physical properties, houses, apartments, commercial buildings, or REITs, real estate investment trusts. Why invest in real estate? Generates passive income from rent. Property value can appreciate over time. Diversifies your portfolio beyond stocks and bonds. Risks. Property management issues. Market downturns can reduce value. High upfront capital requirement. Example: buy a rental property for $200,000, rent it for $1,500 per month, and benefit from property appreciation. Tips for beginners: consider starting with REITs to invest in real estate without buying a property. Location and property quality matter most. 6. Commodities. What are commodities? Physical goods like gold, silver, oil, or agricultural products. Why invest in commodities? Hedge against inflation. Diversify a portfolio beyond stocks and bonds. Risks. Prices are highly volatile. Affected by global events, weather, and supply-demand changes. Example: buying gold or silver ETFs is a safe haven asset. Tips for beginners: treat commodities as a small portion of your portfolio. Avoid trading based on hype, focus on long-term strategy. 7. Cryptocurrencies. What are cryptocurrencies? Digital currencies like Bitcoin, Ethereum, and others. Blockchain technology ensures security and decentralization. Why invest in crypto? High growth potential. Diversifies traditional portfolios. Risks. Extremely volatile, prices can swing 50% in days. Regulatory uncertainty. Example: Bitcoin price jumps 100% in 1 year but drops 40% the next. Tips for beginners: only invest what you can afford to lose. Start small and educate yourself on technology and trends. 8. Alternative investments. Examples: peer-to-peer lending, art, collectibles, startups. Why invest in alternatives? Potential for high returns. Diversifies portfolio outside traditional assets. Risks. Can be illiquid, hard to sell quickly. Higher chance of total loss, especially in startups. How to choose the right investment. Know your goals, short-term versus long-term. Assess your risk tolerance, high risk versus low risk. Start simple, focus on broad market ETFs or index funds first. Diversify, mix different assets to balance risk and return. Keep learning, read, watch videos, and track your progress. Actionable steps for beginners. Make a list of investment options you understand. Decide which risk level fits your personality and goals. Allocate small amounts to different types of investments. Monitor performance quarterly and adjust based on goals. Real-life example. Meet Jason. Started with $200 in an S&P 500 ETF. Added $50 per month to a bond fund. Invested $50 per month in a small REIT. After 5 years, Jason's portfolio is diversified, growing steadily, and he feels confident about his financial future. Lesson: even small, consistent investments across different types of assets make a huge difference over time. Summary of Part 3. Knowing investment types helps you diversify, reduce risk, and increase returns. Start with low-cost ETFs, mutual funds, and bonds, and explore other assets as you learn. Real estate, commodities, and cryptocurrencies are options once you're more experienced. Always align your investments with your goals and risk tolerance. Guide to Investing, Part 4, Diversification, a key strategy. What is diversification? Diversification is basically not putting all your eggs in one basket. It means spreading your money across different types of investments, industries, or even countries. The goal: reduce risk while maintaining potential returns. Think of it like a balanced meal. You need protein, carbs, and veggies for optimal health. A portfolio also needs different asset types for financial health. Why diversification matters. Reduces risk. If one investment crashes, others can offset the loss. Example: stocks drop, but bonds or gold can hold their value. Smoother returns. Diversified portfolios don't experience wild swings as much as concentrated ones. Less stress, more peace of mind. Exposure to opportunities. Different assets perform well at different times. Diversification lets you capture gains across markets. How diversification works: the magic of uncorrelated assets. Uncorrelated assets move independently. When one goes down, another may go up. Example: tech stocks drop 10% in a month. Meanwhile, gold rises 5%, balancing your portfolio. The goal: protect your money while still growing it over time. Types of diversification. 1. Asset class diversification. Spread money across stocks, bonds, real estate, commodities, and sometimes crypto. Stocks equals growth, bonds equals stability, real estate equals passive income, commodities equals inflation hedge. 2. Industry diversification. Don't just buy tech stocks, include healthcare, finance, energy, and consumer goods. Reduces risk if one industry suffers a downturn. 3. Geographic diversification. Invest not only in your home country but also internationally. Emerging markets may grow faster than developed ones, balancing slow local growth. 4. Investment style diversification. Growth versus value stocks. Short-term trades versus long-term investments. Small cap versus large cap companies. Diversification strategies for beginners. Start with index funds or ETFs. Broad market ETFs give instant diversification across hundreds of companies. Example: S&P 500 ETF covers 500 top U.S. companies. Mix stocks and bonds. 70% stocks plus 30% bonds equals moderate risk, steady growth. Adjust based on age and risk tolerance. Add real assets. Real estate or REITs provide income and inflation protection. Consider international exposure. Emerging market ETFs, international stocks, or global mutual funds. Rebalance regularly. Portfolio changes over time due to market movements. Rebalance every 6 to 12 months to maintain your target allocation. Example: a well-diversified portfolio. Meet Emma, a 30-year-old investor. 50% in U.S. stocks, via ETFs. 20% in international stocks. 20% in bonds. 5% in REITs. 5% in commodities, gold/silver. If U.S. stocks drop, international stocks or bonds can reduce the loss. Over 10 years, Emma's portfolio grows steadily without huge stress. Common diversification mistakes. Over-diversification. Spreading too thin can reduce growth. Example, owning 50 different individual stocks might be hard to manage. Ignoring risk correlation. Buying multiple assets that all move together doesn't truly reduce risk. Example, multiple tech stocks in one sector. Neglecting rebalancing. Portfolio drifts over time. Without rebalancing, risk exposure can increase unexpectedly. Chasing trends. Avoid putting all money into hot investments like crypto or speculative stocks. Tips for beginners to diversify wisely. Keep it simple. Start with 2 to 3 asset classes. Add complexity as you learn. Use ETFs and mutual funds. Instant diversification without buying dozens of individual stocks. Invest consistently. Dollar cost averaging spreads risk over time. Monitor and adjust. Keep your portfolio aligned with goals and risk tolerance. Real life story, diversification saves the day. Meet Jake. Invested 100% in tech stocks in 2020. During a market crash in 2022, his portfolio lost 40%. After learning about diversification, he reallocated 50% stocks, 30% bonds, 10% REITs, 10% gold. Now, when the market dips, he only loses 10 to 15%, while still growing steadily over time. Lesson: diversification doesn't prevent loss, but it protects your portfolio from catastrophic drops. Quick action steps for you. Review your current portfolio. Identify overexposure to one asset, sector, or country. Add uncorrelated assets, bonds, real estate, commodities, international stocks. Set up a rebalancing schedule every 6 to 12 months. Track your portfolio performance and adjust gradually. Summary of Part 4. Diversification equals spreading your money across different assets, sectors, and geographies. It reduces risk, smooths returns, and exposes you to opportunities. Start simple with ETFs, stocks, and bonds. Avoid over-diversification, ignore trends, and rebalance regularly. Guide to Investing, Part 5, Value Investing. What is value investing? Value investing is all about buying assets for less than their intrinsic value. You're essentially looking for bargains in the stock market. Instead of chasing hot trends or hype, you focus on fundamentals. The goal: buy undervalued stocks and hold them for the long term. Benefit when the market eventually recognizes the true value of the company. Think of it like shopping at a clearance sale. You see a high-quality product discounted by 50%. You buy it, wait a little, and then it's worth its full price. The principles of value investing. Look for undervalued companies. Focus on companies trading below their intrinsic value. Use metrics like P/E ratio, book value, and dividend yield to evaluate. Margin of safety. Only invest if there's a buffer between price and intrinsic value. Protects against mistakes or market volatility. Long-term mindset. Value investing is not for quick wins. Requires patience, sometimes waiting years for the market to recognize value. Focus on fundamentals. Study financial statements, management quality, and business models. Ignore market noise and short-term fluctuations. Why value investing works. Market inefficiencies. Stock prices don't always reflect true value. Fear and greed often cause mispricing, creating opportunities. Compounding over time. Buying undervalued stocks allows your investments to grow steadily over years. Psychological advantage. Avoids the stress of chasing hype or timing the market. Encourages rational decision-making based on facts. Key metrics for value investors. Price to earnings, P/E ratio. Measures how much you pay for $1 of earnings. Lower P/E can indicate undervaluation. Price to book, P/B ratio. Compares stock price to company's book value. P/B less than 1 can indicate potential bargains. Dividend yield. Indicates cash returns from dividends relative to stock price. Debt-to-equity ratio. Evaluates financial health. Less debt often means safer investment. Free cash flow. Measures cash generated after operating expenses. Positive cash flow is a sign of a healthy company. Value investing versus growth investing. Aspect value investing, growth investing. Goal: buy undervalued stocks, buy stocks with high growth potential. Risk: lower risk, slower growth, higher risk, higher reward. Time frame: long-term, medium to long-term. Metrics: focus, PE, PB, dividends, revenue growth, earnings growth. Example: Coca-Cola, Johnson & Johnson, Tesla, Amazon. How to start value investing. Identify companies you understand. Focus on businesses you know and can analyze. Check financial statements. Revenue, profit, cash flow, and debt are key indicators. Look for undervaluation. Compare current stock price to intrinsic value. Be patient. Wait for the market to recognize the true value. Avoid panic selling during temporary downturns. Diversify. Even value investing requires diversification to manage risk. Example: value investing in action. Meet Lisa. She noticed a strong company whose stock dropped 30% due to temporary market panic. Analyzed fundamentals: low debt, consistent profits, strong cash flow. Bought shares at a discounted price. After 3 years, the stock recovered and grew 70%. Lesson: value investing rewards patience, research, and rational decision-making. Tips for beginners. Start with blue-chip companies. Established businesses are easier to analyze. Avoid market hype. Ignore trending stocks or social media buzz. Use ETFs for value investing. If individual stocks feel risky, try value-focused ETFs. Stay informed. Read annual reports, earnings calls, and industry news. Track your investments. Regularly review your portfolio but don't react to short-term noise. Real-life story: the Warren Buffett example. Warren Buffett is the king of value investing. Buys undervalued companies with strong fundamentals. Holds them for decades. Example: Coca-Cola investment in 1988. Buffett's patience multiplied his returns over the years. Lesson: value investing works for ordinary people if they stay patient and disciplined. Actionable steps for you today. Pick 1 or 2 companies you understand. Research their financial health, P/E ratio, PB ratio, debt, and cash flow. Compare the stock price to intrinsic value. Start small, invest only what you can afford. Track progress over months and years, not days. Summary of Part 5. Value investing equals buying stocks below their intrinsic value. Focus on fundamentals, margin of safety, and long-term holding. Avoid hype, diversify, and be patient. Even beginners can start small and build wealth gradually using this strategy. Guide to Investing, Part 6, Portfolio Optimization. What is portfolio optimization? Portfolio optimization is the process of structuring your investments to maximize expected returns, minimize risk, align with your financial goals and risk tolerance. Think of it like tuning a car engine. Each part must work together for maximum efficiency and performance. Why portfolio optimization matters. Maximizes growth potential. A well-optimized portfolio balances high growth and stable investments. Reduces unnecessary risk. Avoids overexposure to volatile assets. Aligns investments with goals. Short-term needs, long-term growth, and retirement plans all factor in. Improves confidence. Knowing your portfolio is optimized reduces stress during market fluctuations. Key concepts in portfolio optimization. 1. Risk-adjusted return. Measures how much return you're getting for the risk taken. Example metrics. Sharpe ratio compares portfolio return to risk-free rate and volatility. Sortino ratio focuses on downside risk rather than total volatility. 2. Asset allocation. Dividing investments across different asset classes like stocks, bonds, and real estate. Proper allocation is the foundation of optimization. 3. Correlation. Measures how assets move relative to each other. Goal: combine assets with low or negative correlation to reduce overall risk. 4. Rebalancing. Adjusting your portfolio periodically to maintain the target allocation. Prevents drift caused by market movements. Steps to optimize your portfolio. Step 1. Assess your current portfolio. List all investments, stocks, ETFs, bonds, real estate, crypto, etc. Calculate current allocation percentages. Step 2. Define your goals. Short-term goals, 1 to 3 years. Medium-term goals, 3 to 7 years. Long-term goals, 7+ years. Step 3. Determine risk tolerance. Conservative more bonds and stable assets. Moderate balanced mix of stocks and bonds. Aggressive higher allocation to growth stocks and alternative investments. Step 4. Choose optimal asset allocation. Use a combination of stocks, domestic and international. Bonds, government and corporate. Real estate or REITs. Commodities, gold, silver. Optional, crypto or alternative investments for high-risk appetite. Example allocation. Conservative, 30% stocks, 50% bonds, 10% REITs, 10% commodities. Moderate, 50% stocks, 30% bonds, 10% REITs, 10% commodities. Aggressive, 70% stocks, 15% bonds, 10% REITs, 5% crypto. Advanced Portfolio Optimization Techniques. 1. Modern Portfolio Theory, MPT. Introduced by Harry Markowitz. Goal: maximize return for a given level of risk using diversification and correlation analysis. 2. Efficient Frontier. Graph showing the best possible return for each level of risk. Helps investors choose the most efficient portfolio. 3. Monte Carlo Simulation. Uses probability modeling to predict potential outcomes of a portfolio. Helps in understanding risk under various scenarios. 4. Risk Parity. Allocates capital based on risk contribution of each asset, not just dollar amount. Balances portfolio volatility. Practical tips for beginners. Start simple. Don't overcomplicate with advanced theories initially. Focus on proper allocation and diversification first. Automate investments. Use robo-advisors or automatic ETF contributions to maintain target allocation. Review and rebalance regularly. Check every 6 to 12 months and adjust. Avoid emotional decisions during market swings. Track performance with metrics. Sharpe ratio, Sortino ratio, or even simple ROI. Ensures portfolio remains aligned with goals. Real-life example, optimized portfolio success. Meet Sarah. Age 35, moderate risk tolerance. Portfolio, 50% US stocks, 20% international stocks, 20% bonds, 10% REITs. Uses dollar cost averaging and rebalance every year. Over 10 years, portfolio grows steadily, surviving market crashes without panic selling. Lesson: optimized portfolios balance growth and safety, making long-term wealth building sustainable and stress-free. Common mistakes to avoid in optimization. Ignoring correlation. Investing only in similar assets increases hidden risk. Over-rebalancing. Rebalancing too frequently can incur unnecessary costs and taxes. Chasing returns. Adding hot investments without analysis disrupts optimization. Neglecting goals. Optimization must align with financial objectives, not just numbers. Actionable steps for you today. List all current investments. Define your goals and risk tolerance. Check allocation across asset classes. Rebalance portfolio if allocations have drifted. Track performance and adjust gradually, not impulsively. Summary of Part 6. Portfolio optimization equals maximizing returns while managing risk. Key strategies: proper asset allocation, diversification, rebalancing, and risk-adjusted returns. Beginners should focus on simple allocation, automated investing, and regular review. Advanced investors can explore MPT, efficient frontier, and risk parity for deeper optimization.